This week I've got a bit of a grab bag. Seen a lot of questions both to my inbox and on Facebook. And this is an area where kind of there's some general ignorance about how taxes work and how the tax code works. So I wanted to cover three separate things. The first, I've seen a couple people talk about, well, I don't do my business expenses because I use the standard deduction. That's totally irrelevant. The standard deduction is how much you owe in taxes. Your business expenses determine whether your business had a profit or a loss, which then affects if you owe taxes. But you can take the standard deduction and still itemize all of your business expenses. The choice you have to make in your taxes is whether you itemize your personal deductions or you take the standard deduction. But you should always be itemizing all of your business expenses. The second mistake I've seen is a lot of people are asking about, well, how do I report my kids' income? And well, you don't on your taxes. If your children have income, whether that's because they have a job, whether that's because you pay them, whether that's because they have investments, if they owe income tax, they have to pay that income tax themselves. They need to do their own filing. And while it is rare, it does happen that, 1, 2, 3 year olds may make enough income if they're doing certain things where they have to file federal taxes. And state taxes are quite common because some states have a very low tax threshold. So if your child has income and if they owe taxes and they're a minor, doesn't matter if they're a minor or not, they have to file their own taxes. Now, if they are minor, they may get hit with what's called the kiddie tax. The kiddie tax basically says sometimes they have to use your tax rate for any of their non-earned income. So if you give them a whole bunch of investments, they get taxed at your rate instead of their rate. That's to stop people from basically avoiding the taxes by giving the assets to their kids. But even then, they still have to file their own tax return. They just basically need to use information from your tax return. The third thing is we're not quite in the same ballpark, but it has to do with a mistake a lot of people make to avoid probate, but it ends up costing people a lot of money. So probate sucks. If someone dies, it's really a pain in the ass to have to go through everything. If you have a lot of assets, you really should consult with some sort of a legal professional about setting up a will or a trust or both. That said, I hear a lot of people who do things like, well, I don't want my kids to have to go through probate for me, so I'm going to give them my house now while I'm still alive, and that will help. That way they don't have to do probate. Well, first of all, there's a decent chance they'll have to do probate for other property anyway, so you're not necessarily saving them any money. But even if that is stopping them from doing probate, you could be costing them tens or hundreds of thousands of dollars in taxes to avoid that maybe $5,000 or $10,000 probate cost. That's because of what we call the step up in basis. So when you buy a house and then sell a house, you owe tax on the change in value. So if you buy it for $100,000 20 years ago and now you sell it for $500,000, that's a $400,000 gain. Now, maybe you can avoid that tax if you're an owner of the property, but maybe not. But if you give it to your kids, they're going to owe that tax. Well, if you wait until you die to give it to them, it works totally differently. And that's because the basis, the number we use for kind of what did you buy it for, becomes the value that it has on the day of your death. So in that exact same case, you have a $100,000 house that goes up to $500,000. You now pass away. Your kids sell the next day. They have no gain on that, and they owe nothing in taxes. And let's say they're paying 20% capital gain at the federal level, which is very common. And maybe they're in a state with a state capital gains tax of 2 to 3%. You literally could be talking about $80,000 or $90,000 in taxes on that situation. So to avoid the probate and a little bit of paperwork, you just potentially cost them nearly 100 grand. And I've actually seen cases where it's much bigger, where it was, originally about a $200,000 or $300,000 purchase and then a $2 million sale. At that point, you're talking about hundreds of thousands of dollars in additional taxes. So before you do anything with major financial ramifications, make sure you understand the rules. Consult with me, consult with somebody else.